3, 2, 1. Happy New Year.
It is a Happy New Year edition.
We had the Christmas edition. Now we have the New Year's edition. I don't remember the last time that both these holidays were on a weekend. It's been a while.
Yeah. I don't know.
Honestly, everything's been a blur for the last 3 years.
Yeah.
Like we were talking about last night, I think it was, I am ready for 2023.
Yeah, for sure.
Yeah, nobody can really see it unless I can't move the camera. But above our TV up here,
Yeah.
there's a buddy of ours that threw a New Year's Eve party back in 2020, and it says FU 2020. It's a nice sign. I might retire that sign in 23 just because it feels like 2020 has lingered.
Not only that, we need an FU 2022. I mean, if you ever want to flip off a year for investing anyway, this
for
is
investing. Yeah,
Holy
2020
moly.
was more for just in general
COVID.
chaos of the world.
Yeah.
But I think it was just a prelude.
Yeah, for sure.
To 2023 or 22. Sorry, 22. Yeah, man. I'd never really give a hoot what the freaking year is or the date. I don't even know what the day is half the time. Yeah. But I'm kind of ready for a new year.
Yeah, I'm ready to flip the calendar for sure.
My New Year's resolution is forget about 22 and 21 and 20. Forget about the last 3 years. Just move on.
Yeah, definitely. So there's a lot of stuff to look forward to, honestly. I don't know. I mean, there's a lot of lingering bad stuff in terms of the market and all that. But
yeah, I'm sure we're going to get into some of that.
Yeah, we'll talk about some of it. I can't, we did the members-only call last night, and I'm putting together the newsletter for this weekend and, put together the show here. And I can't keep track of in my head of what I talked about.
What we already talked about.
Yeah.
Who was it with?
Yeah.
Who was I talking to when I did that?
But there's so much, 23. We did a show a couple weeks ago about the consensus view of what's going to happen in 23.
Mm-hmm.
And part of that is that the consensus is usually wrong, which is good to know. Right. It doesn't mean that it's always wrong, because it's not.
Right.
And literally.
But we rarely, when I say we, I mean like everybody, right? Rarely get it right.
Right.
Never call it perfectly.
Right. I posted an article this morning, I think. So Friday morning from, I don't know, Bloomberg or somewhere, but it talked about how all the analysts got earnings expectations right for 2022. So the forecast at the end of 21 for 22 about earnings was correct. And yet nobody caught the bear market.
That's crazy.
Right? So, I mean, it kind of goes to, number one, earnings aren't the end-all, be-all, right?
Right.
But number two, more importantly, the forecasts, I mean, they were all very bullish on 2022.
Mm-hmm.
But it was pretty clear. I mean, I say it's pretty obviously everything's clear in hindsight, but it was pretty clear if you were watching the price action at the end of 21 that at least the beginning of 22 was not going to be good, which is why we were very quick to get out on January 6th. That started the majority of the G fund for us for 2022.
Yeah. You got any good charts and the stuff that we talked about last night on the member call?
No.
Performance stuff?
No. Oh, the performance, yes.
Okay.
Yeah, the performance stuff, yes, but we can talk. Remind me at the end. We'll talk a little bit about what I think is going to happen in 23, and it's.
Listen up, folks. Jerry's going to get out his crystal ball. You better be listening.
Yeah, it's not my crystal ball. It's the consensus, and I just want to kind of
put it on record.
Put it. Well, if the consensus actually happens, right? So So the consensus is basically that the market rolls over. Everybody knows that a recession's coming. The only question is how bad the recession is going to be. Everybody knows, quote unquote, knows it's going to happen in the first half of 2023. And so the expectation is that stocks go down in 2023, first half, and then have a big rally in the second half. Okay, that's the only. And we talked about that in a show a couple weeks ago. The only difference in the consensus is how low we go in the first half. And so, therefore, how much we recover in the second half. And I think the range was something like, big, J.P. Morgan and Wells Fargo and whoever we went through like 10 of them. The range was something like we would end 2023 at like 4,500 at the high and 3,800 at the low, something like that. So it depended on how low we went. in the first half and how far we came back in the second half. So they're basically all the same. It's just degrees, right? Mm-hmm. And so if that happens, okay, they all agreed basically on this. If that happens, stocks go down. Investors flee, quote unquote, flee to the safety of bonds. Okay, so the bonds go up, stocks go down. So what does that mean for us? The only bond exposure we have is the F fund. It's a lot more on a percentage basis. There are more treasuries in bonds in the F fund than there are corporate bonds, but they're a combination of both. Corporate bonds should go down with the stock market in the first half, but treasuries should go way up. Okay, because when you're fleeing the stock market, you're going to the safety of government bonds. Okay, so if you, like in the mutual fund window, for example, you would want to find a fund that tracks the TLT ETF or the ZROZ ETF, because those are long-term government bonds. Those should go up the most. For TSP, all we have is the F fund. So stocks go down, F fund goes up. At some point, so obviously you want to be in the F fund when the F fund's going up, and you don't want to be in the stock funds when the stock fund's going down, right? So potentially we could see 10% gain on the F fund in the first half of the year, and then flip from the F fund to the stock funds for the second half of the year to get what they expect to be a big recovery in stocks in the second half. So there's a lot of potential, and I'm pretty actually excited about 2023, and I hope that the consensus is right, because if it is, I'm like all over it now about how we're going to take advantage of that in TSP.
It'll be easy.
Yeah. So having said that, I doubt the consensus is going to be right. I don't know how it's going to play out. And so that's we went into a lot more of that in the members only webinar last night. So
well, there you have it. Show's over.
Yeah. Yeah. So I don't have any charts about that, but that's the consensus, and that's how we would play it in 2023 if it turns out that way. Okay. So what we're going to talk about this week, a little update on the Santa Claus rally. We are halfway through the Santa Claus rally period. Actually, there's 2 more trading days. It's a 7-day period. We're recording this on Friday, so Friday's kind of the midpoint, a little bit later than the midpoint. 2 more trading days, and first 2 trading days of the year, and then we'll complete the Santa Claus rally period. And we're gonna look at our performance. This is something everybody's been asking for, and Conan's done a ton of work in getting this whole thing together, and I think you guys are gonna like what we have. And then the TSP fund charts. Okay. So we put up this chart last week. It's from Stock Traders Almanac. So according to Stock Traders Almanac, what should happen is, this is the average. Okay, so it's going back from 2001 through 2021. Are these lines here? This is what actually happened on average over those years. And then what's happening right now in 2022 is these dotted lines. Okay? So when they put up the chart, this is where we were. We were between the 10th and 11th trading day. Okay? And these numbers down here are, I put in the actual dates. So the Santa Claus rally went from the 23rd of December to the 4th of January. All right? So that means right now we are 30th. So we're theoretically, this is where we should be on the stock funds, right? We should have bottomed somewhere in here in mid-December, and on average, we would have been up here with mid to small caps leading the way, which is, for us, is the S fund. And that's not what happened, right? So here's what actually happened. So this one's from All Star Charts. JC Peretz, we talk about him all the time. And here's a kind of where we are. This is that red tick right there. That's as of the close on Thursday. So the Santa Claus rally period began on the 23rd. So it began at the beginning of that shaded area. We came up a little bit, came down, and then Wednesday had a huge rally. Thursday, huge rally. Friday is not looking very good as we're recording the show. So if we come back down here, and then we have a couple more days, if we get above this level, then we will have a positive Santa Claus rally. In the big scheme of things, this is the December high. We're not going to come anywhere near it. So even if we do get officially, we get up here at the close of the second day of trading in 2023, even if we get up here, it's not going to be a very significant move. There isn't much to the upside to go, and virtually everybody thinks we're going down from there. So the importance of the Santa Claus rally, we talked about it last week. It's a trifecta, really. You have the Santa Claus rally period, then you have the first 5 trading days of January as the second piece, and then you have the January closing price as the third piece. And if all 3 of those are positive, then the year tends to be positive by 90%. 90% of the time, if all 3 of those are positive, then that year is positive. And it's the average when that happens is positive 17.5%. So it's a pretty big deal. And the Santa Claus rally is the first part of it. So, if we do technically get a Santa Claus rally, that's good, because now at least we've ticked off the first piece of the trifecta. If it follows through to the first 5 trading days of January, even if it's just a little bit, that's good. And then if we somehow get a positive for the month of January, that'll be great. But again, this is all statistical, so we'll see how it goes. Okay. So we talked about this picture, I think, last week or the week before. I continue to get hate mail about this one. But if it's what's the term what's the term that we talk about being disruptive?
Being disruptive. Yeah.
So this is a chart of math. It's a picture of math, right? The disruptive piece is that
people don't want to believe it.
Yeah, they just this idea that you need to stay invested, and I can't miss the best couple trading days of the year, and all this stuff. At the end of the day, the reason why rule number 1 is don't lose money is because it takes so much gain to offset your losses, right? If you are down 50%, it takes 100% gain just to get back to even.
Right. Most people think it takes 50%. That would be my kind of math.
Yeah, it's
right? I'm not
intuitively
a math major,
right.
But you think stuff, I'm back up where I was.
Right.
50%. Nope. It takes 100%
of what you have left.
What you have left.
Right. To get back to even.
And that's why we don't want our account balance to go down.
Right. It's and we're going to show here in a second why it's critically important not to lose money. And so okay. This is a 3-year chart. If you started with $100,000 in TSP, back here, this is as of the close in November. So 3 years ago, 2019. So the end of November 2019, you started with $100,000 in your TSP account. The G fund you can see is flat. It's that blue line right there. It's basically flat because the G fund doesn't go down, and it goes up very slightly. So that's why it basically looks flat. The F fund is orange. On a relative basis, it's kind of hard to tell on this chart because it's a 3-year chart, but the F fund from here in 2021, this decline in the F fund is pretty epic. It's historic. But the F fund obviously is going down. Ordinarily, the F fund does not go down along with the stock funds, as we've talked about. Usually, the reason you have a 60-40 portfolio is because if the stock funds are going down, the F fund is supposed to be going up to flat to offset that decline in the stock funds. But this year, we didn't get that. So why is it so important not to lose money? This right here. Oh, let me just finish. So the gray is the C fund, right? And S fund is yellow. And if you followed our alerts over that 3-year period, you're in green. Okay. So how can we be so far ahead on a relative basis from the stock funds and the F fund? It's because of this right here. right? This is COVID. And if you were following our alerts back, before COVID, we got out of the stock funds literally the day before the first major downturn in COVID. And so that's why if you don't take the losses, you don't have to get out at the exact top and you don't have to get back in at the exact bottom. But if you can avoid the big losses, you wind up way further ahead at the next starting point, which is why on a 3-year chart we're still way above any of the stock funds. So we're starting off on a 3-year basis from a much higher place.
Yeah, and so that chart is about account balance, right?
Right.
That's what we're always trying to get people to explain. And so if you guys want to know anything about our performance now, plenty of people have been asking forever. It's all 100% transparent on our website now. You can go there and you go under what we do, and a drop-down menu is our performance. And every month we have hired an outside firm so that it's,
we're going to go through that, the charts of all that.
All right. Yep. So bottom line is that's where you can find the information that Jerry's showing. I think the 5-year chart is the one that's on the site, but we have 1, 3, and 5. I just don't put all those charts up there because it takes too much room on the website. I like the 5-year chart better because that gap there is massive. Because we have well outperformed all that, and that and I know Jerry's going to get into this. That is not our goal. Our goal is not to outperform the market. It's very difficult to do that. We did it, but the real takeaway is what Jerry's talking about. Is our primary focus is not having those catastrophic losses.
Right.
And people, we were talking to some guy at dinner last night who was just so adamant, buying the red, and we're like, and he's in the TSP. And I'm like, okay, man, I mean, your account balance is going down.
Yep. I don't know why you would do it. I mean, if you knew a house was going to be cheaper tomorrow, would you buy it today?
Yeah.
Of course not.
No, it's a depreciating asset.
Yeah.
Your account balance is going to anyway. We go off on a tangent, but the bottom line is don't listen to us. Look at this chart.
Yeah.
Look at that. That is data. That's math. If back up a couple, the ones where everybody hates that one. If you hate that one, you're really going to hate this
you're
one.
You're really hating that one
because the green is what your account balance would look like if you started with $100,000 last November. And you took a snapshot at the end of this November.
3 years. No, 3 years.
I'm sorry.
3 years. We're going to get to 1 year next.
Okay, go ahead. I'm going to stop talking.
Yeah. No, so just one thing I wanted to kind of point out. So when the gap, right? When the gap decreases, so we're like this section right here, let's say. Again, this is a 3-year chart, right? So when the gap decreases, it means we're on a relative base. During this time frame, we're losing compared to the S fund, right? When the gap decreases, it means we are underperforming. So during this time period here, as the gap decreases, we underperform the S fund. But as soon as really all the funds, but as soon as the S fund rolls back over and we're in the G fund, which you can tell we're in the G fund because it's flat. All these areas that are flat are times when we are 100% in the G fund. And while that's happening, the stock funds are going down, and so the gap increases. So we're relatively outperforming the stock funds during that time, which is why on the members only call we always talk about how our methodology tends to outperform, during certain conditions and tends to underperform during other conditions. But overall, avoiding these big losses is real, and obviously as this continues to expand, it's because we started off at the beginning of January, as everything was going down, we're staying flat. And so this just expands more, right? So you're not making any money. This is the other thing. We basically are flat. We're up like 7% for the year. But that's not, it doesn't really matter. The point is, it's what it is relative to what you could have done, which all we can do in TSP is the 3 stock funds and the bond fund, right? So the best you can do when the stock market is going down is to be in the G fund, which is basically flat and up a little bit. That's the best you can do in TSP. So, all right, that's what it looks like on a 3-year And again, that alert at COVID was what got us there. Then if you zoom into the 1 year, it's even kind of more clear, right? If you've been following the alerts for the past year, you had $100,000 at the end of November in 2021. So here's December. The G fund is blue. We're in green. You can see for most of the year, we're in the G fund, right? We took some losses, right? We weren't positive all year, right? We took some losses. We took some, you can't really see it back in there. We took a little bit of loss there. We've only done like really 3 main moves. It looks like we've actually done 18 to be honest. I'm going to show that in a second, but overall, we were in the G fund for most of the year, which basically gives us a risk-adjusted return. So now our gap here, we're on a relative basis, we're much higher than the stock funds, and we did it being mostly in the G fund, which means your risk was 0 for most of the year. If you guys kind of get the hang of that. All right. So Colin was talking about our performance on the website. He's revamping the website, and we hired a guy to do this algorithm to figure out our performance. And I'm gonna talk about that here. So this is if you go to what we do, our performance tab, you hit that drop down, this is what comes up. This is the time frames. This if you look at the TSP site, these numbers, as of the end of November, for example, the year to date is minus 13.11%. If you look at the TSP.gov site, and all these are the same on TSP, so you can kind of confirm it from there. And again, we are, let's see, on a 1 year, year to date, we're a little under 8% on the 1 year. So this is our kind of performance over the years. And so how do we do it? It doesn't look like this on the website, but you can get this too. I think it goes back to, what did you do it back to 2012 or 2015?
No, it's only a couple of years on the new website.
Yeah.
Mostly because I saw that no one was going back any farther.
Yeah.
If somebody is just that curious, I'll be happy to send you the file.
Yeah.
Because what we do is we track, every time we reallocate, every time we change the model, we call it the grow fund. Right, just to keep it consistent terminology. It's not an actual fund anymore. That the L funds aren't actual funds; they're just a portfolio. So, just call it a model or a portfolio. So that's what the grow fund is. And so every time we change that model, reallocate within that model, we make note of it, obviously, and the closing prices and what have you. So these performance numbers you see aren't really difficult math. The reason we hired someone else to do it is out of I forgot the terminology. Basically to give credibility to it, right? We didn't do it on the back of a napkin. We hired an outside firm who has absolutely no interest other than the fact to get it correct. And we actually had it audited by another firm. So the point is that's just math, right? And so what we're able to do now that we haven't been able to do in the past is just update that data at the end of every month.
Yeah.
We really do it at the beginning of the month for the previous month. So sometime early January, you'll see the site change to as of 12/31 or whatever, right? And so every month you're going to be able to see all of that change, which is great. Which a lot of people have wanted that level of which, by the way, if you guys will put this in perspective and go try to find how many quote unquote advisors or people in the education, financial, which is what we do, education, not advisory, but that are that forthcoming about their performance. Right. They're normally not, because they're nowhere near that. Right. We're pretty happy with it, but it's not about that as much for us. It's about not losing money and being on the right side of the market. But everybody was so obsessed with the numbers that we said, okay, we're going to give it to them. Good or bad, we're going to give it to them. Yep. And it's on the site. So.
Yeah. Yep. It's on the site. I put up these slides just so you guys can see.
So this is so this is like one of our internal documents that shows the fund price is the closing price, And then, on 120, that's when we made a reallocation, changed the model.
Right.
And so those are the closing prices we got for that. And then there's a lot of, financial calculations that are going on to show the performance. But basically, it's two sets of numbers.
Yep.
It's the sets of numbers when we make a change in the model and what the closing price is from TSP.
Yep. And so the firm that we had do it, they just pull the closing prices from TSP, and we tell them when we made the reallocation.
Yeah,
and that's
we
all
show
there is
them.
to
We
it.
literally
give
show
them
them
this
this.
chart.
Yeah.
And so this year, for example, this was as of the 31st of December 2021. We made these reallocations throughout the year. This is the percentages that we went to. This came down.
And all of that's on the website also.
It's on the website now, yeah. And so this came down to the 11th of July. We started back with the 11th of July, and then we did these for the rest of the year. So we did 18. Our last reallocation of the year was the 29th of November. We went to 100% G fund.
The only one you can't see on the website is the current one,
right?
Unless you're a member. If you're a member, obviously you can see it. You log in and you can see the current. And just so you guys know, in case you're new to the show or this in general, you can go back. I think it's the previous alert and the previous alert analysis are public, meaning once we've gone past that alert and made another one, the previous one, we make that public. So why? Well, you can go back and look and see why we made the decisions, why we changed the model. And again, all of this is about transparency to see what's going behind there's no wizard behind the curtain.
Yeah.
You're
looking at them.
There's a few other wizards involved, but they're not on the camera very often. But anyway, the point is, folks, we can't possibly pull back the curtain anymore.
There isn't any more curtain to pull back.
And back up that one slide, two slides. There you go. It's on the website. So I can't tell you how many emails and Facebook messages and what have you. Well, what's your 3 month and the thing and I'm like, dude, okay, here you go.
Yeah.
Here you go.
I mean,
everything.
We had to hire it out. We didn't have time to.
No way.
Or the Excel experience to be able to go through and create all that stuff.
That's true too. I mean, we did it, but so what we did before, again, going back, Jerry's been doing this for decades, right, folks? So this isn't new. But then it didn't become what it has become until probably 3 or 4 years ago, right? And so, we were just basically like everyone else, relying on the TSP,
right?
The thrift savings plan to tell us the performance. Well, all they share is the PIP,
right?
Which is great as an individual. It does not work. It's apples and oranges. My PIP versus your PIP. It doesn't. You can't compare the PIPs. There's a whole show about that. You can also Google it, and it'll explain why. So that's not a very useful metric when we're doing something what we're doing, right? And so then we switched to daily TSP and started using theirs. The only problem with that is, when they changed the website, things got kind of wonky. And then we just decided, we don't want to have to rely on some other thing, right? So we said, all right, we're going to hire an entity to do it for us. And so these guys are financial analysts, is what they do. And so they built all this, right? And all we did was just give them access to I mean, you guys have access to the same information.
Yeah.
That's the key. So if you're a financial, wizard, you have exactly the same data
all the
available.
information's on the site.
On the website. Nothing is hidden. So I just kind of want to keep putting that disclaimer out that first of all, it's rare to find anybody that's willing to do that. Second of all, we did. So if you want to go do the math, you can do the math yourself. It's all there.
So this was the firm that we had do it.
There you go. Yep.
Okay. So
Krug Investments.
Krug Investments. Krug Investment Solutions out of Princeton University. This is his LinkedIn page. If you guys want to read it and see it, he's been in the business for quite a while, and he's the founder and CEO of Krug Investment Solutions.
Pretty sharp guy.
Yep, very sharp guy. All right, so you guys got the hang of it. If there are any more performance questions, send them to support@growmytsp.com.
Don't send them to us.
All right, TSP fund charts. So, we talked about the Santa Claus rally and kind of the relative importance of it, but in terms of the overall chart, not too much has happened this week, right? Here's the C fund. We are it's going to be a little bit lower probably. I mean, as of right now on Friday, the market's not looking too good, so we're probably going to close a little bit lower than where we are here. The 3,900 level has been really, really important. Actually, it's kind of hard to see in a weekly chart, but 3,900 level has been really important. As long as we're below 3,900, there's no point in being in the stock funds. But from a weekly perspective, again, we always do the 3-year weekly just so that we can capture the COVID, which is going to be dropping off the chart here in a little bit. But if you're only looking at TSP once a week, this is the 20-week moving average line. Once we got back above that line after COVID, every time we corrected a little bit, we came down and got support at that line, right? All the way along until January of this year, we closed below it on a weekly basis. And that was the beginning of the new downtrend. And then ever since then, we were able to poke up a little bit above that 20-week moving average line, but it's basically acted as resistance throughout the whole year. And we have an all-time high, lower high, lower high, lower high, lower low, lower low, lower low, lower low. So you can see the trend. Doesn't mean this is going to happen, but the trend obviously is that we continue down and get a new lower low. And there's a lot of talk about the bottom being at somewhere 32, 3,300. So does it look like that? You know, sometime in the first half of the year, it's very possible. That's the consensus view. We don't know until it gets there, but as of right now, for the past 3 weeks, we have been below that 20-week moving average line. RSI below 50, and MACD has not crossed negative yet on a weekly basis, but histogram is definitely pointing down. So no reason to be in the C fund at this point. S fund, same kind of idea. Once we got back above it after COVID, all the support in the S fund all the way along until for the S fund, it was it rolled over earlier, so it was like November 2021, and kept hitting resistance at that 20-week moving average line. Got a little bit above it here at that summer rally, but then again, lower low, lower low, lower low, right? Lower high, lower high, lower high, and it looks like we're continuing the downtrend. RSI below 50, MACD is just about to cross negative. S fund is not looking good. I fund clearly has been outperforming the C and the S fund. Ordinarily, the funds tend to move up and down together. This whole thing in the I fund is because of the price of the US dollar. So we've talked about that on several shows. When the price of the dollar goes down, the price of the I fund goes up because it's they're international companies, and so when it costs them less money to buy dollars, the value of their companies go up. And this is, of course, the international fund, and so that's why we have price going up on the I fund when it's going down on the S and C. So in terms of technical analysis, right, as long as price is above that 20-week moving average line, RSI is above 50, which it is. MACD had crossed positive back here, right? It's looking like it's maybe rolling over, but right now we had a buy trigger on the I fund back here on that week, and the buy trigger is still in place. So I'm not saying go out and buy the I fund right now. I'm just saying that if you had bought it, if you were watching the shows and you had bought it back here when on a weekly basis, I fund closed above above the 20-week. You can see right there, it's the same time we crossed 50 on RSI, and MACD had crossed a little bit before it. So the stuff works. We do it for our subscribers on a daily basis, but on a weekly basis, it works also. So the I fund buy trigger is still there. F fund we talked about. It's what we're watching the closest right now for the first half of the year. So we started out. We had the top here back in the middle or so of 2020. So this move down in the F fund has been going on for a long time, and it's the biggest move down in bonds since like 1750. It's absolutely an historic crash in the bond market, and so that's a big part of why analysts are expecting that once this thing starts moving higher, it can really move higher. So, for example, if we got back up to here, right, as a resistance point on the F fund, that's about 110. I mean, let's say we're at 100. That's a 10% move. Okay, so
10% gain in the bond fund would be nice.
And the F fund would be pretty unbelievable, right? Yeah. And so what we're looking for is, this is what we talked about in the beginning. If stocks roll over in the first half of the year and bonds move higher, right now, if you drew out a chart of the stock funds, it basically tracks the same as the F fund. So what has to happen is the stocks would have to come down in the first half, bonds would come up in the first half, and that's the point that we're looking for. And once we see that point, that's when we put out an alert. And the alert is going to be pretty substantial in the F fund. However, the trend has been stocks and bonds moving down throughout 2022. So to get this divergence, it means that this long-term trend, this trend that's been going on for over a year, has to flip. And so that's what the consensus is that at some point in the first half of 22 or 23, that flip is going to happen. And it's going to be painfully obvious in the chart. So that's what we're looking at. If you want to know when we're going to take advantage of that, sign up at growmytsp.com.
Questions. If you have questions, you can put them in the comment section wherever you find this video. If there's no comment section, you can always hit us up at support@growmytsp.com.
Yep.
If it's anything personal advice, investment advice, we're probably not going to answer.
Not going to do that.
But if it's questions in general about technical analysis or our methodology or all that stuff, great. Support team will help you, or one of us will jump in. But we get lots of great questions from folks that actually help us, put together stuff for the show. So if you ask a question, the way we think about it is, there's probably hundreds of other people who have the same question.
Yep.
So especially if we hear the same question more than once, then we're like, oh, well, hey, we got to put this in one of the shows and talk about it. And Jerry's great about putting together a whole slide deck on, one thing that he saw on a Facebook comment. And that's great, because that's what we're here for, is to teach you guys. And so we hope, you and yours have a healthy and happy and prosperous 2023.
Absolutely.
And we are going to try to do the same.
Yes, we will.
All right, guys. You have a great week and a great year, and we will see you
next year.
Next year.
All right.
Absolutely. And if I can find the right button to push.
Dong.
There it goes.